Hello and a warm welcome to you all. I'm Chris Payton, Chief Investment Officer with La Trobe Financial. Today, I'd like to share an overview of our business and portfolios, including the release of our FY22 annual report and our recently updated product disclosure statement. And in some further good news for investors, I'll talk you through further increases to our portfolio crediting rates effective the 1st of November, with each of our offerings continuing to demonstrate their position as leading sources of low volatility, inflation-responsive variable income. So let's kick things off, and I'll start with a corporate update. La Trobe Financial has long been recognised as one of Australia's leading asset class specialists. We commenced our operations way back in 1952, and we now manage about 15 billion in assets under management. We have over 460 staff with offices in Melbourne, Sydney, and corporate offices in Hong Kong and Shanghai, making us a national and increasingly international asset manager of note and scale. Our staff are continuing to execute on that same fundamental strategy that this company was founded on, which is serving the underserved borrower and serving the underserved investor. Our business operates through two distinct but very complementary segments, being the asset management segment and the real estate credit finance segment, each of which I'll unpack for you now. Our asset management business, spearheaded by our $8.5 billion credit fund, has over 80,000 investors and operates in the $3.3 trillion managed fund sector. Through our credit funds, we are taking 7 separate product offerings to market, comprised of pools or exposures of low volatility, high-performing credit assets, with the aim of preserving investor capital and providing variable monthly income to every one of our 80,000 investors. The assets of each of our offerings is entirely backed by La Trobe Financial originated loans. And that brings us to our second business segment, our real estate credit finance business. Now that business draws on our deep expertise in credit to deliver one of the broadest mortgage product suites in the $2.5 trillion residential and commercial mortgage markets. Our RecF segment originates, assesses, approves and ultimately settles mortgage assets, which are ultimately invested into by our credit fund. The group maintains a particular focus on high-quality borrowers with complex credit propositions that don't necessarily suit banks' automated credit assessment models. Both engines have been built from the bottom up over time with discipline to withstand and perform through all cycles of the economy, and experience that over 80,000 investors in the credit fund know all too well, with no investor in any of our portfolio accounts having ever experienced a loss of capital. Now, what differentiates La Trobe Financial from peers is our highly diversified, mature pools of liquidity. That is, our diversity of funding. We are unrivaled in our sector domestically and, to the best of our knowledge, globally, by maintaining deep and proven funding spanning some of the world's largest banks and financial institutions, debt capital markets, while also operating a fully scaled asset management business. This gives us unparalleled diversity and cross-cyclical strength to perform and to capitalise on growth and portfolio opportunities beyond those that our peers can pursue. It has allowed La Trobe Financial to break through the capacity ceiling that restrains the originate to securitise business model of non-bank peers, removing that single point dependency on capital markets and bank funding, which is particularly important during times of market volatility, which can bring with it debt capital market or institutional market choppiness. And that's to the benefit of all of our investors. We are a business which prides ourselves on our market-leading transparency and reporting, and it is through that lens that we have recently published our comprehensive credit fund annual report for FY22, and that is available on our website. Long-term investors of La Trobe Financial will have often heard us say that getting rich slowly never goes out of fashion. And having recently celebrated our 70th anniversary, La Trobe Financial remains dedicated to our aim of providing investors with consistent returns across every economic cycle, particularly during uncertain times such as those experienced more recently. Now, we have been refining our investment approach since 1952 and strive above all things to be good stewards of our investor capital. We deeply respect and appreciate that reservoir of trust that we've built with our investors and will do everything we can to preserve that. The benefit of consistency does not simply end with repeatable investment returns for investors. Second-order impacts of reliability are building tangible wealth within Australia and being recognised by eminent rating agencies as providing a high-quality offering. Against the backdrop of nearly 2 pandemic-impacted years, we are pleased to report that our 80,000 plus investors in our $8.5 billion credit fund enjoyed yet another year of consistent returns. Each of our portfolio accounts continued their proud history protecting investor capital and delivering monthly income. Across financial year 2022, our portfolio accounts saw total investor distributions of an extraordinary $271.8 million, returns that outperformed benchmarks and provide investors with variable sources of income. With a view to obtaining an independent lens of the credit fund and its ongoing performance, we engage with rating agencies and research houses from time to time who undertake a comprehensive examination of the credit fund and its individual products. And having recently completed the annual review of the 12-month term account, it gives me great pleasure to confirm that Lonsec, who are one of Australia's leading research houses, has affirmed its recommended rating of the 12-month term account. Now, this marks the 10th consecutive recommended rating the account has received from Lonsec, which is a real testament to the resilience and longevity of the strategy. Within the report, Lonsec reaffirmed its confidence in the strategy, noting amongst other things that our structured and robust credit approval processes executed by a well-regarded team, diversification of our loan portfolios and the 12-month term accounts, low standard risk measure. Finally, to our PDS, which represents the ongoing terms and conditions which govern your investment with La Trobe Financial. Investors will be aware that we periodically update this document, and I confirm a new version has been released effective from the 29th of September. Now, there have been no changes to our investment mandate, no changes to our portfolio construction fundamentals, and no changes to our credit approval processes embedded in that PDS. Put simply, changes cover industry-wide disclosure obligations around fees, RG97 for those inclined, and additional disclosures for current or prospective investors in New Zealand. The updated PDS is available on our website, or a copy can be made available by contacting our friendly asset management team on 1-800-818-818. Honing in now on the 7 credit fund product offerings I talked about during our corporate update. And our credit fund has grown organically through a long-term management-led focus on product excellence. And to this point in the business cycle, it has been leveraging that 70 years of corporate history and experience in diligently assessing and manually underwriting complex prime mortgage assets. And they've delivered an impeccable performance history for our investors. It is fair to say that times of market volatility do showcase well the benefit of resilient, uncorrelated offerings like ours. Take our 12-month term account, for example, which is comprised of approximately 10,750 individual, granular and low LVR loans that perform exceedingly well for investors across the cycle, including in times of market disruption. And that was really evident during the COVID-19 pandemic, with our conservatism throughout the pandemic seeing us navigate that period with our strong track records well intact. Now, that conservatism included the purposeful tilting of our portfolios towards excess liquidity and taking overweight positions in vanilla residential mortgage assets, through which we address the first order impacts of the pandemic. Now, I'll touch on the second order economic impacts shortly and how our portfolios are positioned. In the meantime, I can confirm that those multiple tailwinds we have discussed with you over previous months, which are driving our performance and boosting our distribution rates, continue to persist. We have reinvested our excess cash reserves with liquidity levels back towards long-term targets, and in other words, we are back to being fully invested. We've also normalised our credit asset appetite, which sees portfolios tilt towards their more income-generative norms. And finally, market interest rates have been increasing, and quite quickly at that, with those returns benefiting investor returns. Each of these in isolation would move the needle in our income profile. Combined, they are real and meaningful tailwinds which have allowed us to increase our portfolio crediting rates to the rates on screen now. Given that the macroeconomic environment remains volatile, it's perhaps timely that we drill down into our portfolios a little deeper, which are constructed to withstand and perform across the cycles. Now, the remarkable performance of the 12-month term account is outlined in the chart on screen now. This performance takes the requirement to time the market off the table and is part of the reason advisors and investors alike make a strategic allocation across our products. A moment ago, I mentioned how we addressed the first order impacts of the pandemic, and that was through a tilt of our portfolios to a more conservative, granular, resilient asset profile. Addressing this as we did left us extraordinarily well placed to deal with the second order impacts now present within the market, particularly the increasingly volatile economic environment. As we traverse this new period of volatility, we begin it having already tilted our portfolios towards more conservative assets. We begin it with our borrower asset quality near its highest ever level, and we begin it with arrears at or near their lowest ever levels across each of our accounts. This positioning keeps us best placed to continue our delivery of low volatility variable income. Of course, when constructing our portfolios, we have a keen focus on maintaining and uplifting our disciplines with the aim of protecting investors against periods of economic or property market downturn. And perhaps the best insulator for our investors, particularly during periods of property depreciation, is high quality borrowers with conservative loan to valuation ratios. And if you consider our maximum LVRs for each of our portfolio accounts, they are set at conservative levels, with the average right across the credit funds sitting at less than 65%. Now, this provides significant downside protection for investors in our portfolio accounts. We have long spoken about the importance of diversification in the construction of our portfolios, and those portfolios have been built with discipline over time, the careful selection of granular asset exposures diversified across sector, loan size, borrower type, and security location. Now, this level of diversification is really rare in our sector and can be often overlooked when times are good, but really protects and insulates investors during times of market stress and volatility. In our case, we have maintained flawless liquidity right across our history in relation to our portfolio accounts, with no investor in any of those accounts ever having suffered a loss of capital since inception. Now, a question which I'm sure would be on the minds of many of our investors is the ongoing performance of our assets and how our borrowers are performing and will perform in a rising interest rate environment. Now, let me start off by saying that through our disciplined credit assessment process, every loan application is reviewed by at least 3 separate fully trained members of our 200-strong credit team prior to approval. This hands-on deep dive process is a real point of difference as we get to know our borrowers and ensure we are writing loans to the highest quality applicants. This disciplined and comprehensive assessment process is critically important to ensuring that we're settling and ultimately investing into loans that will continue to perform irrespective of the market or economic cycle. Now, it would be naive of us to suggest that there won't be some mortgage stress in the market and indeed segments of the portfolios with rates increasing as they have. It may be counterintuitive, however, to date, after continuous increases, our borrower arrears have fallen month on month. In fact, the 12-month term account sits at its lowest arrears level ever, which speaks to the resilience of our borrowers and the economy more broadly, and the strength of the household balance sheet built throughout much of the pandemic. Now, make no mistake, arrears will increase, but they're at their best possible position to start this period, and we envisage that they will simply increase back to longer term averages, i.e. they will normalise, which we are very comfortable with. Now, we encourage you to monitor any of the hundreds of data points we make available each month through our monthly snapshot and metrics, which we publish on our website, and welcome any queries you may have about any single one of them. Thank you for taking the time to hear our business and portfolio update.